What's up, everybody? We're back with Jacob's PC in the penthouse floor of 39th, 595 Madison. I'm having some great guests tonight. I'll start with Bob Nackel from JLL. Got the gentleman Eric Brody with Annex Partners.
You know it.
And we got Richie Zav with the developer. Very nice. Very nice to meet you all. Very nice to see you all. And let's talk about construction, development, distress. And let's start with construction today. What are you seeing in the field of construction today, E? Tell us what's going on in the market. Tell us what's going on Midtown, downtown. Tell us.
So we're going to keep it NYC.
Let's
is
take
that
it a
what
bit.
we've decided here?
Yeah.
We'll keep this a New York City marketplace.
Oh, yeah, definitely.
So I like to always talk about anecdotal and real life experience.
Let's rock.
Parking my car today, one of the largest open shop carpenters in New York is going, what's happening? There aren't as many bids coming in, less architects sending out their drawings to bid, less GCs asking me to bid. What do I do? In addition, one of the largest facade open shop contractors in the city I was with today, and he's saying, E, we're concerned. We're picking up a big project. We'll be okay. What about the future? And I said to them, 10,000 new units coming to market. Adams wants 50,000 annually. We have shut off the spigot, and we are seeing in the multifamily space a, lack of housing. We need housing, and what happens is a trickle-down effect. You're seeing it on the front end with the architects. They're not billing. They're not putting out drawings. You're now seeing it where GCs are going to get less, and those subcontractors are starting to suffer, and that's today in this moment. That's what I see in construction.
Is that stall construction, stall condos, rentals, development sites? What are we really talking about?
Well, when those projects stop, it's just work, right? They don't perceive it as like a stalled site the way that we look at it, and we'll get into. They see it as their work available. Can they get a job? Can they keep their manpower? And can they keep billing? And the concern is on their faces. Now, remember, subcontractors and general contractors aren't necessarily looking at an annualized basis as to the work that's coming to them. They're looking at it monthly. So if a subcontractor is coming to me and telling me that they have an issue, that means right now in this space, people are suffering.
Oh, so Bob, what are you seeing? What's going on with the development sites?
Well, Leo, I'll tell you, the development is dependent upon what sector of the market you're talking about. Condo land is still selling, but prices are down 25 to 30% just in the last 16, 17 months because construction loans are so expensive. Office land, there's very, very little of. Hotel land, virtually nothing has sold simply because the special permit you have to get. Since de Blasio put the special permit requirement in, a total of, I think it was 0 applications have been made for new hotels. And now because of the lack of tax abatement, we have a huge air bubble in the development pipeline for rental apartments. And to tack on to what Eric said about what the contractors are saying, what they're feeling, and that is going to get more and more acute as we move forward. The politicians who are not in favor of a new 421A, and I talk to politicians all the time. I've had this conversation with the mayor and with the governor, and I tell them supply solves all the problems within the housing market. They don't get it. And the politicians who are against 421A say it's just a giveaway to the developer community. They're going to build anyway. Oh, yeah? Well, look at the statistics. The last year of the 421A, in Manhattan alone, 1.6 million square feet of rental housing built. 2 years later, 38,000 square feet of rental housing built. The Affordable New York program kicks in under Cuomo. The last year of the Affordable New York program, 1.5 million square feet of rental housing built. 2 years later, 68,000 square feet. That's math. That's not an opinion. So any politician who thinks that tax abatements don't impact whether people build or not are not looking at the facts.
All right. Do you agree, Richie, with Bob and what Eric is saying? You got a different perspective.
No. Bob and Eric are giving you facts, and I'm going to explain to you how I know that. I am building now. I was building in 2021, and I'm building now, currently in 2024, and I have projects scheduled till 2028. So you mentioned how your friend is unaffected this year, but he is worried for the next years. I'm not as worried, but let me tell you, if the fear of God has not yet hit any developer or contractor, any of the bankers or brokers, they're not real players. Contractors are squirming for business, reaching out to me, rebidding on their own things. They're giving me certain price point in contracts proposals, and then a week later they're lowering their prices. Not because they desperately have so much work, but it's because they desperately have no work, and they need to keep all of their insurances, their overhead, their offices, their salary. Everything needs to stay the same for them. They want to live and survive and feed their team. And to circle back on the tax abatement, I'm building under the tax abatement for condos, and I'm building under the tax abatement for rentals. And under the rentals, there's two parts. There's HPS for homeless. So anybody that's buying for $80 to $120 a foot in the Bronx, that was their game, the HPS program. Everybody else that was buying in Brooklyn or Queens, even parts of Manhattan, it was doing regular affordability, 70-30 splits, they're not doing anything now. And because in June 15 of 2022 was the cutoff to put in your foundation, and then they made it even worse. They gave you a timeline until you have to finish these projects at 2025. So now what's happening is there was a supply of development sites. There was a supply of stalled sites. And now there is a tremendous demand for affordability because people are not making as much as money. Banks are not loaning money. Therefore, you're not cycling the money around. And there's no inventory that's being presented for 2025 and 2026. So whatever is left is going to be absorbed. What will happen is one of two things, which will both push us. Option A is we're going to feel a reappreciation because there's no inventory for affordability. And then option B is if they don't lower the rates and they understand, like you said, the politicians figure out that the simple math, no one's building, they must release a 421A of some sort. They will not do it under the same 70-30 AMI, 130% AMI, 70-30 split.
Right.
They'll probably do a 50-50, maybe a 60-40, and they'll take the 130 and reduce that all the way down to 70 AMI, which stands for average median income, which they have a rubric on.
So there's a lot of factors in coming into this distressed market. Is the market really distressed? Because what I'm seeing with developers right now are the effects of their decision-making power 2-3 years ago. They got into these interest rate loans, whether it's fixed or just going up and down, yo-yoing really, and now they don't have any more profitability. And that profitability has withered away. Are you guys saying that it's because of 421A? Are you guys saying what are you guys saying?
It's two issues really.
Yeah, tell us.
One issue is just the fact that the policymakers are hypocritical. They all say they want New York to be more affordable for everybody, but yet every single piece of legislation that's been implemented or ignored since 2018 has done nothing but constricted supply and exerted upward pressure on rents. So rents are going up. It's very hard to find an apartment, and there's several things you can do.
Hypocritical, but for their voting populace, seem to be relevant. Right?
Maybe,
but yeah, it depends. You have to be willing to increase supply, and yes, that brings people into a neighborhood that don't know you, might not vote for you. You have to get over that.
Right.
It's almost like at the city council, they defer to the local council person to make the decision about these things. It's almost like that council person shouldn't be allowed to vote. Everybody else should vote.
Correct.
Because of the self-interest that exists there. But the reality is we've constricted supply. That's exerting upward pressure on rents. That's generally a good thing for the property owner. So these politicians who won't take donations from the real estate community are actually increasing the value of those properties because rents are going up. Where the distress is coming in, Leo,
tell me,
is that folks had gotten mortgages at 3.5% or 4%. Those mortgages are maturing today, and you're replacing it with debt that's twice as expensive.
Right.
And the value of the building has probably gone down for a number of factors. So you're getting less proceeds, and it's more expensive. That's what's creating the distress. You have a mortgage maturing. You had an $80 million mortgage. The bank says, yes, I'll refi. I'll give you $60. First of all, does the owner have the $20 million to effectuate the refi? If they don't have it, the writing's on the wall. If they do have it, they have to decide, do I put $20 million of fresh equity into this building to hold on to it? That's a tough decision for folks. So that's
because they're making so much, let's say, in just the regular markets or whatever it is. It's that $20 million when you're at that level, maybe there's a better investment to be made.
But they can't, Eric, they can't make that investment. So let me tell you guys, I guess, the ending of where the developers actually end up when they're they're not marking to market, right? When the lender's not marking to market, that's a fancy way of saying that the value of the loan right now is 50. The value of the loan, meaning the debt itself, is 80. So they're not selling it at 50. They're trying to still get their $80 million. So what's happening with these lenders are they're trying to decide whether they're going to dispose of the asset, number one, by themselves, and they're going to Bob Knackel at JGL and trying to sell it. And he's like, look, this thing is underwater. So Bob Knackel pings it back to me. And I'm like, you know what? I'm going to go to a new developer and see how much they can create value. So I ping it back to Rich, and Rich is like, Leo, I can't do anything with this unless you get the bank to take 25% of the value down. And I go ping it back to Eric, and Eric is like, well, I can't get the capital if you, again, get him back to 25%. But it seems like the lenders are having trouble understanding that. Instead, what they're doing is, and I just came out of a mediation, it was a $76 million property, a huge property, I believe, in Brooklyn. 60 units, I believe. It was about 60 units. It's probably a rental play or a condo play, I forget. But the value of the land right now is $15 million. 2 years ago, a year and a half ago, was $37 million. So think about it. You have a lender that already has funded 37 out of $76 million loan, aggregate would be $100 million value post-construction, is now dealing with the property. It's $15 million.
Half built.
Well,
Half built.
That's what I wanted Bob to elaborate on. Just for a second, for those that don't understand, you mentioned something about the value of the building and a 60 and a 20. Can you just elaborate for those that don't understand that there's something called a debt service coverage ratio, and the more the capital costs us, the less the debt service coverage will be reflected. A lot of people don't understand that when you're refinancing, it's not just what the building is worth, but there's a formula that needs to be applicable to the bank, which will then go back to what you're saying, aka margin call, right? Banks,
Yeah,
A huge margin call.
There are hurdles that you have to achieve. And so there's being in default because you're not paying. Then there's technical default because your debt service coverage ratio isn't there. Because if your new mortgage rate is so high, it's going to eat up more of the cash flow. Your debt service coverage goes down.
What else is higher today?
Pardon?
What else is higher?
Insurance.
Yeah,
Insurance.
Everything is higher today. Look,
That's right.
tell me. Look at Class B and C office buildings. Anybody would say, today they're trading between $250 and $350 a square foot for B and C office buildings in the Garment
But
Center.
what were they trading? Give us what they were.
They were
what were they?
trading
Yeah.
for $600, $700, $800 a foot.
Even 800 a foot.
And so you look at that, and then Department of Finance comes out with the tax assessments. Tax assessments on those buildings went up 3.1%, according to the Department of Finance. So I want to sell all my office buildings to the Department of Finance since they think the value went up as opposed to
Well, let's just
gone
go
down.
back to that example. So think about it, $800 a foot on a net rentable, right? You can borrow, people talk about it all the time. If you had borrowed 50%, which you and I would have said is actually very low leverage on an asset.
Yes.
Just
Great
based
numbers.
on the
Yes.
value he's saying, it's now 250. Right in there is where the issue is.
Even
That
money.
bank is the one who put in the 50%, and now they're underwater.
But how are
But
this?
let me give you a real life example because I have a client that owns a very, very nice Class C plus building, Midtown West. Got a loan 5 years ago. He was getting rents in the high 50s to $60 a foot, 94% occupied, had an appraisal for $210 million, took out a $100 million mortgage.
That's less than 50.
Very conservative, less than 50. Today, the building's 34% occupied.
Yeah.
The last lease he made was at $29 a foot. The mortgage is maturing.
It's getting crushed.
And the bank said, we'll refi, but we will give you $80 million. And that he has the $20 million. He says, Bob, I'm very lucky. I have the 20,
100%.
but I don't really feel like putting it into this building. So that's a real life example of what happened.
Can I tell you some
yeah,
good news?
Yeah, sure.
Because I don't know if you guys were I know the three of us were there. I don't know if you were there. We were at the Rebney Awards,
Yes, we were.
right?
Great
and
time.
The Rebney Awards happened, and for the first time I've heard in a very long time, the speech from the federal to the state,
To
to
the
the
city.
city,
Yeah.
finally was even talking about saying we need more housing. There's a crisis. Before, that wasn't even the narrative. So I don't know, and you might have more experience than I do. I always see it. I don't even listen because I think it's all BS. But imagine now, maybe, just maybe, they're actually thinking about trying to resolve what Richie is saying, what we're saying, not about valuations, just saying we have a housing problem. We need to stimulate the developments.
Even for those elected officials that think that an Econ 101 textbook is capitalist propaganda, the fact is, during the pandemic in Manhattan, a lot of people moved out. Vacancy soared. Vacancy soaring is like supply increasing. Rents went down by 30%. So if politicians really want to make rents more affordable for people, increase supply. How do you do that? The time in which you have to get your TCO is actually June of 26. The banks want it to be June of 25 to give you a construction loan. There's 60, 70,000 units on sites that are to be built, but they're not starting because they can't make the deadline.
Not only that, they can't get the new capital, which we could talk about with Richie too,
Yeah,
right? You can't, capital's looking through the brand new lens of reality. It moves a lot faster than mid-market. The capital's saying we need this return on our money. Otherwise, we can make 14% doing this or 17% doing that. You have to entice
Selling watches.
Exactly.
People are saying, I'll give you $1 million, but I can make more selling watches.
Exactly.
This is a competition today.
So tell us, Rich, what you've been doing on the developer side. Give us an example of, a benefit you had 2 years ago that you don't have today in developing property.
All right. I'm gonna touch on this. Let's talk about investors, right? People that have a shit ton of money and they just want to reinvest. What's their end goal? Make money as safe as possible. People like the 421A because it's easy to get a loan on. It's easy to raise capital on. It's easy to build. There's over 10,000 applicants ready to be processed. There's over 10,000 people. If you build a 10,000 apartment complex, you can fill that in 1 hour. That's how many people the city's holding back on reserve option that ready approved applicants. Like you build it, they send you 10,000 people. Now think about the two lines I told you about. Free affordability 70-30, which are the more higher sophisticated clients. And then you have HPS. On 10th Avenue, there's a shelter. They're taking them from 10th Avenue, homeless people, putting them in your apartments. They're giving you a 30% premium, and they're giving you a direct deposit on the first of every month, the city of New York. You never see the tenant. Now, here's the biggest benefit, is those units that we're building, let's say, on average $250 a foot, those units that were being built for $250 a foot, the HPS units that you're building them at $200 a foot because you know that you're building them for a homeless client. You're not going to put a chandelier. You're going to put a regular hi-hat. You're not going to put a 24-inch.
Let me ask you, though, how many units are being developed? I don't even hear about this. How many units are being developed under that?
HPS?
Yeah.
All of Bronx, all of Jamaica, all of Ozone, anywhere that you can't get a market rent above 2369 is a specific number so that it wouldn't get rent stabilized.
I have a question. Where's the government not have their hand in policy? I'm hearing about HPS, 421, free market, but how is free market doing right now?
Zero. Rentals, nobody's building it because you're going to spend between 25 and 35% of the average rent roll in real estate taxes.
So how are you supposed to solve the housing crisis?
It's easy, Leo. You can easily solve it. As we said, number one, extend the June of 26 deadline to get your TCO. You'd have tens of thousands of units coming out of the ground within 30 days. If you reestablished the MCI and the IAI program that were both effectively marginalized. I mean, go back to the 1970s when the dilapidation rate in New York was 14%. 14% of the apartments were in such bad shape they were uninhabitable. They put the MCI and the IAI into effect. That produced a great return for investors, and consequently the private sector put tens of billions of dollars into the housing stock. In 2019, dilapidation 0.04.
Now, MCI, though, so the audience understands, is that you would get back for spending money on that dilapidated unit. So it's an existing unit, it's stabilized, but you would get a bonus by putting the work in that would make sense to make that investment. Is that the program you're talking about?
Like the J51.
Yeah, the MCI was building wide. The IAI, individual apartment improvement, was for the apartment. Put both of those programs back to what they were. There are estimates at the low end 30,000 units at the high end, 80,000 units that are just nailed shut because it doesn't make sense to invest in them. Think if you reinstituted both of those programs, all of those units would be under renovation within 2 weeks. How many sinks are you going to sell? How much flooring? How much sheetrock? How many toilets? How many refrigerators? Give me a break. How economically stimulative that would be. Bring back the 421A. Create implement a 421G program that works so beautifully downtown. 9/11, we had 1,800 dwelling units down in the financial district. Today there's 30,000 because of the 421G. You want to convert older obsolete office buildings to residential?
Beautiful.
Do a citywide 421G. All of these things, so simple. When you do them, all of a sudden, you want rents to come down and be more affordable, do these things. Yet every politician will not get on board with this stuff.
And here's the biggest problem, by the way. The city of Florida, Miami, is booming. We're missing out on all the money. When they're going to be done building, we'll be reaping the rewards of everyone moving out. When it's time for us to rebuild, everybody will be already in Miami.
So you're thinking that Miami is going to be building and is going to be ready for the reset when New York is going to be having people essentially exiting Miami? Exiting New York, I'm sorry, to go to Miami?
I 100%. Listen to what's happening. Cost of capital is extremely high. Fed came out today and said they're unchanging the rate. It's not bad news,
But it's not good news.
but it's not great news because we've been shitting our bricks for the last 18 months. Insurance has gone up across the board by 30%. Not just building insurance, car insurance, COIs for contractors has gone up. So that's our cost of labor. Materials have gone up. Buildings have gone up. The renters have ran away. The buyers are on pause. We're transacting with of 100% of New York has now become 60%. And the 60 could become 30 and we're in trouble.
And I'll tell you one thing. Let's talk about transacting. There's transacting in non-distress and there's transacting in distress. I think it's safe to say, at least from my point of view as a litigator, as a professional restructurist, a bankruptcy restructurist, in court and out of court, lenders are still trying to squeeze the borrowers. They're not giving discounts on the loans. But I don't think that's their fault. You guys want to know the truth about why the lenders apparently are not writing down their loans? Because they themselves apparently have investors that they have to answer to, and they can't modify the loan by taking a write-down on that loan. So what they're doing now is they're not allowing the market to breathe, even with a borrower that is in default. And I'm not talking about technical default, as you've stated previously, actual default. They've failed to make a payment. So we're sitting at a mediation, and the lender's like, no, I'm not going to take a discount. We're like, well, the market is in the shitter and the interest rates are up. He's like, well, I'm about to raise interest on you. I'm about to take it back. So I think we're hearing it from all corners.
I think that's a good point. I'd love to hear Bob and Richie's opinion on this, right? You're talking about the capital side, right? And what people didn't realize is that when regional lenders stepped out of the game, credit funds stepped into the game, right? They could make their spreads. Interest rates were rising. There was good money in it. I'm talking about high teens for first position debt on construction financing.
Crazy.
And what we learned was when you're a regional lender, right? You're a bank, you're federally regulated, and you have to mark to market your loans annually, which wind up for when Bob will tell us about what he's selling. You can actually sell those loans at a discount because you were taught to take your hit annually.
Correct.
When you're a credit fund, which is everyone who filled that space, you are a hedge fund. You are a fund that's raised capital from investors. You promise those investors a return. And the structure of that joint venture, much like real estate, may be that there's catch-up provisions, meaning that you can take a part of your profit annually, right? The interest that comes in.
Right.
But if, God forbid, it doesn't go the next year and the profit fades, you, the operator, are coming in with money. So you're not motivated as a credit fund to discount the loan. You're motivated to pretend and extend, even if that's not going to happen, because you don't want to show your investors that you have a loss and you don't have to come up with money.
So just like Sarbanes-Oxley was passed to really temper the banking institutions, I think the private institutions and this is really a democratic value. And we're not going to get into that today, but it's a democratic value that we should regulate the private institutions, and that will resolve our problem. Because if lenders had to take a
Loss.
discount and losses that were covered by the government, just like we've seen in 2008 financial crisis, a portion of the debt that the financial institutions gave out was thereafter covered and insured by the short sale modification program that came out, where if you were, you had a property that was $200,000, now it's worth $100,000, you would short sell it, you would dispose of that asset as a consumer, as a borrower, and they would give you $100,000 basically discount, and the government would basically eat it and give you eat the cost. I don't know. Is it a good idea to have private institutions? And this is probably very controversial, but I'm still going to ask about it.
I got to step in here, guys. I'm going to blow this podcast up. I'm going to give you guys, which was once a secret, is no longer a secret after this moment. Developers don't get stuck. Banks take losses. You know what's worse than not making money?
What?
Not collecting it.
Right, but I'll tell you something.
If a bank says you owe $5 million, you took a $5 million mortgage, you have a 5-year term with a 5-year option to extend, protruding to the fact that it has to be same LTV, debt service coverage ratio. You give them the same rent roll with a 2% increase over the course of 5 years on average. You gave them expenses that have slightly increased, and they're telling you, hey, on your $5 million, you got to make a margin call. We need you to put $1 million into the equity. If you tell the bank no, developers, real developers, they don't get stuck. 99 out of 100 real developers, now there's not that many, they know how to renegotiate the terms with the bank to properly tell them, my friend, if I tilt, you coming with me.
Right, but they have their personal guarantees in the loan.
Yeah. No, not that I.
They got to collect. They have to absorb this asset. Let's not talk about $5 million. Let's talk about
philosophically, I get it. If
Like,
if
we're
you
talking
owe
about
$5 million to the bank,
$5 million
they
is-
own you. If you owe $5 billion,
Let's talk
you
about
own the bank.
Let's talk about
But, like,
one developer that has high liquidity with the bank, 20-year relationship,
Tell them to call me.
20-year relationship, and he's done nothing but take and give loans, take and give, and now he starts to expand in 2018, 2019. He buys 1 lot, 2 lots, 3 lots, 4 lots. He puts plans into place. COVID happens. He survives COVID.
Yeah.
And he takes 1, 2, 3, 4 loans during 2021 when the interest rate or Fed was at 5 points. And he absorbs $250 million one shot. Now the bank is like, oh, it's a good developer. He's got good personal guarantees. Now I'm not talking about the other 30 or 40 clients that are experiencing the same problem.
Right.
What, are they going to let him default? If they let him default, they're defaulting. And you know what's worse than showing that they're investors? The institutional banks and the publicly traded companies that have to report quarterly earnings and they have to go to the Fed Reserve, they need to show them they're going to take a loss. For every dollar that you withdraw, they need to put in 8.
I appreciate that from your mouth to God's ears, I guess, about how a lender should cooperate and how a lender should negotiate. But that's not what I'm seeing in this litigation and mediations and arbitrations. What I'm seeing is the lenders are playing really hardball. And they're basically saying, we will modify it. We will put the interest on the back end. We will extend the terms of your loan. But we're going to give you a rubric of which to follow. And it's going to be our rubric. But because if you don't agree to follow our rubric, we're going to file a receivership application and take the property back until you either behave or we take the property from you. So I disagree. I
Leo,
think
is there a difference between different types of lenders? Are money center banks behaving differently than SNLs or is the foreign bank behaving differently? Are there differences of different categories of lenders?
Absolutely, 100%. So I had the Bank of India, okay, which you can bleep it out, but whatever. I'm going to say I blowed up their spot. Bank of India was extremely cooperative. Okay, you give them a call, and their attorneys are extremely cooperative. Then you have, Madison Realty Capital. Okay, they're a bit more aggressive. They're a bit more astute. They're going to really rate their risk with this borrower. And then there are other private funds, which have a very different attitude. They'll literally look at the papers, they'll see their borrower not doing well, and the next day they'll default them on a technical default and try to take their property, because lenders are also human at the end of the day.
It's actually very human, more human than your perception of it is. They are literally looking at the credibility of that borrower,
Right.
whether they're truthful, how they act as a reason
Right.
to make the decision, right? Because
Right.
think about the lender's position, right? It's discounted that the total cost is the lender's position. There's many things that you can do before it's their issue.
Right.
And they just want to see your credibility. Have you done this before to get paid back? Because nothing that happened in the past means that it's going to work for the future, but that is how that they look at each of their borrowers.
And I'll tell you one thing, Bob, you are correct to ask that question, but I think a better question to ask is, how? Yes, Leo, the lender's temperament is different depending on the actual lender, but also the borrower's temperament is different with each lender as well. So it's a two to tango. It's
Who's playing
not
offense?
one.
Who's playing defense?
Yes. And right now, if I were to suggest, because I represent a lot of developers, the who's who in the market of New York City, Brooklyn, Queens, Manhattan, and what I've been finding is they're laying a very, very tough attitude of against their lenders.
Yes.
Why? Because they're like, look, it's not me, the borrower. It's not you, the lender. It's the market or it's the government. And the lenders are not listening. They're saying, okay, you took that risk. I'm not your partner. And then when you get into mediation and arbitration and litigation, they're like, well, could you give us an equity kicker, 15, 20%? Let us get the upside, and we'll discount here and we'll discount
Yeah,
it
but
there.
they don't want to be. Listen, developers don't want to be developers in this market. Banks don't want to be developers or landlords. They don't have the management systems and processes in place. They don't want to take your property and finish it. They don't know shit about construction.
But why are they being so
You know
aggressive
what?
then?
I just want to be clear. You have to be careful with that, because there was a very famous company called iStar Financial. That was a lender. Guess what? It took every asset, became a developer, and killed it. So you got to remember, these guys are also
Out of how many?
I'm just saying, you have to know who your lender is, right?
Yes.
And just, so there's a difference. You're right. Certain people, you can leverage that and state that, and I agree with you, but not all of them. If you look at some of the guys that are operating in New York City, they built and then became lenders. That's one of the premises as to why they're doing that type of financing.
Exactly
So
right.
you got to be, I'm not saying it's not right what you're saying. It's just not a global, right? It gets into a nuanced position.
It's not a global rubric for.
But Leo,
yeah.
you want to tell me you're not renegotiating interest rates with banks? That would be hard for me to believe.
So the answer is yes, and the answer is no. It's yes if, like Bob said, the attitude of the lender is amicable. But sometimes you got to tenderize the meat over there.
If they're looking at the personal financial statements,
They're not. We're never going to let them look at it, because if you're at the point in litigation when you're looking at the personal financial statement, allow me to finish.
Pre-litigation.
Yeah. Well, even pre-litigation, we're not sharing that information, because everything you're going to be giving a lender to prove that you as a personal guarantor can pay something back puts you in a more difficult position. Why? Because the lender says, oh, great, he actually does have the assets. We're definitely defaulting him. We're definitely going to receivership, and we're definitely not going to go to mediation because he has all the assets to pay back. And then you're scurrying, trying to hide him, which is illegal. It's a fraudulent conveyance. Please don't do that. Please don't go and collect $100 and do that. Go to your lawyer. Please call, your attorney.
Jacobs PC.
But yeah, you are negotiating. And then there's the no. Then there's the yes then there's the no where they're like, we didn't do anything wrong. We're actually not your partner. And we're going to sue the fuck out of you to make sure that we get not only that piece of land, but we will also go after you personally. And then they'll tell you it's nothing personal.
What if they
Listen.
don't have a PG signed?
No, we can get into the nuance of it. Let's talk about something that I think is relevant to the four of us. And I'd love to hear Bob, because of his wealth of knowledge, on the following subject. We're seeing, right, because it's about the return based on risk-adjusted returns, okay? And that's how we create this new market of buyers or people doing deals, right? Because we keep talking about transactions down and all the shit that's happening. What about moving forward? So think about cost of capital, right? You have senior lenders, right? They're looking for these spreads, and you're seeing these funds, and they're getting teen returns on first position debt for construction financing and land. Then you've got mezz and pref, right? 18 to 22 is what they're searching for. And as Bob will tell you, a lot of them, what is common equity's expectation in order to underwrite, to refinance, or to do any deal in New York City? So
In
Bob,
this market? No.
in this
nothing.
market. So Bob, and everyone's coming to me for pref, mezz, senior, and common equity, and I'm shocked. What do you think it's going to take, Bob, to get transactions going again? And then from the people that you see, because you're seeing the players that are structuring the deal,
Yes.
what is their return expectation now
tell
on
us
new
about that.
stuff? Let's tell me the new world now. Let's forget about how screwed everyone is. How's the new world looking at wanting to buy a deal?
Well, if you're talking about a construction project,
Yeah, let's talk about
Anything,
that. Let's talk
yeah.
about construction.
development
Come on.
models, everybody's looking for at least a 2x equity multiple. Deals were underwriting a lot tighter. They were down 1.5, 1.6. And it was tough to see things pencil to more than a 5 cap or a 6 cap on new construction. And then cap rates on existing started to get to the same level. People said, why would I take the development risk if I could get
buy something ready to go.
existing cash flow at
Exactly.
the same
Exactly. That's
level?
what all my developers saying.
So it's changed, but I think what we need to see is we need to see some stability in the debt markets.
What do you mean by that? What do you mean by
But
stability?
I mean, rates coming down. I think people are starting to feel, if you took a consensus of market participants, very, very few people think rates are going to go up from here. They don't know. We don't know when they're going to fall or how much they're going to fall, but people are pretty confident, hey, they're not going to go up. That's a very positive thing for the market.
Okay.
But once you start to see maybe a couple of reductions in rates, that's a positive sign because the base rates impact lending rates. And then we'll maybe start to see more competition to put money out. And then also you're going to give comfort to the equity players. There's still a lot of equity out there. There's a ton of equity.
On pause.
It's just really expensive. Because
Really
look,
expensive.
if you don't want to put money out, and you're an equity fund, you don't say, hey, I'm not putting money out now. You say, yeah, sure, I'll put money out. Yeah, I want 22%. So effectively, you're saying I'm not in the market, but you're not saying you're not in the market.
Can I blow up? Yeah.
So you need comfort and certainty, which will compress spreads, will get more equity in the game. The more equity that's in the game, the more competition there is, the lower yield expectation that equity has, the more lenders that get in the game, they compress spreads as they get more competitive to put money out. And then you get into what economists refer to as a positive feedback loop, which is a positive, but we're not near that now.
But just to say to our audience, compressing spreads means you can pay more, right? When you are acquiring that asset and developing it, it's more accretive cost to the asset instead of giving a lender money, right? It's less interest to them, more that you can actually just spend on the actual asset, right?
Well, and it's more yield that you will make is paying the same.
Right, you
thing
pay
for
the same, but
property.
you just make more money.
Well,
So my question though is, you're seeing that. So what's happening right now? Are the bid asks off?
We have not reached capitulation, right? I thought we had reached during every rebound. You have to get through what we refer to as the capitulation phase, where people who want to sell finally say, "All right, you know what?
Lens of reality.
selling."
I
Are we
call
there
it.
yet?
I
Are
like
we there yet?
capitulation.
No,
No,
Almost.
we thought we were in the third quarter. I
Almost.
think if you look, we always use as a barometer the Manhattan investment sales market, because whatever's going to happen in the city will happen in Manhattan first. We look at the market for deals over $10 million south of 96th Street. First quarter of last year, there were 42. Second quarter, 43. Third quarter, 84. I said, 84, it doubled.
Yeah, we're going.
Maybe we're reaching capitulation, but I always caveat my take on the market by saying trends only happen after 2 or 3 quarters. You can't
Correct.
base it on one
Consecutive.
year.
correct. Consecutively.
Consecutive quarters.
Consecutive quarters.
And the fourth quarter stunk. I mean, it was 33 sales. So it was
We're on
the
to-
low-
we're
one of
on
the
to
lowest.
something.
But Bob,
Right?
in the trenches, what
Shit.
what are they saying to you? Did they show you their underwriting, meaning the buyers? They're like, this
Sometimes.
doesn't make any
No,
goddamn,
but
this
I
doesn't
think
make any sense.
It's at this point, it's much more important the sentiment. And I think one of the conversation I had, look at the uber wealthy class, right? The folks with 9 figures of liquid net worth sitting in the bank that are real estate guys and gals. And you brought them deals over the past 2 years. The conversation was identical every time. Bob, it sounds like a really great deal, but it's going to be cheaper in 3 months, so I'm going to wait.
Yeah, right.
They're not saying that anymore.
What are they saying?
They want to get back into the game because the Fed has said, hey, we're not going to raise, we might lower. And before the inflation numbers came out 2 weeks ago, the expectation was to be February or March, there'd be a cut. Now the inflation numbers were not good. Who knows when they're going to cut? But that capital has said, all right, I want to get into the market, and maybe we're near the bottom. And you can never get time exactly the market at the bottom, because you won't know you're at the bottom until 6 or 9 months after you're beyond the bottom. And I told these rich folks, I said, look, in the GFC, value bottomed out in the second half of 2010. Do you think everybody that bought in 2009 isn't thrilled that they bought that deal in 2009?
Yeah, but if you're too early, which is also what I hear, which is fascinating, the guys that were buying up, sort of inventory condo on the cheap, then when they went to the market, it hadn't popped yet, and their returns weren't there for what their expectation was. If you waited another year, they killed it, right? So it's fascinating to hear that you don't perceive that capitulation is there.
No,
I keep hearing about the cost of capital. I'm like, I can't underwrite an asset that makes sense for you to put money in. What we're seeing is just in markets outside of New York.
But Eric, what's happened is simultaneously, because it's had a two-pronged effect, the Fed's statements. The capital now wants to get in. But the flip side of the coin is that the sellers who don't have to sell, there's two big batches, three batches of sellers. There are the folks who have to transact.
Right.
Death, divorce, taxes, partnership, dispute, whatever. We love those folks. Then there are the folks who...
Those are my folks.
Leo loves those folks.
Then there are the folks who have a very compelling strategic reason to sell. Portfolio realignment. I'm selling B and C properties. I'm going to buy A property.
Right.
I'm selling in New York City. I'm going to go buy in Florida, Texas.
Right.
I'm selling all my multi. I'm going to buy industrial, whatever the case might be. And then you have the basket of truly discretionary sellers who only sell because they can get a good price. Each of those 3 buckets, they have a very different mindset, perform very differently. But what has happened is the folks who are not in bucket 1 are saying, oh, the Fed's going to cut rates. This really disappointing price that I've been offered, I'm not going to take that. I'm going to wait. If rates are coming down, my price is going to go up.
Yes.
So it's created a little bit of inertia, and the gap still exists only because even though all the capital wants to get in, the sellers are a little more hesitant now.
They're lagging.
You know what we're also seeing, which is, I'm curious if you hear the same, is the 9-figure guys, they were like, you know what? I'm going to get into credit. Why am I getting to the asset? I can get into credit, be first position, and do like a crazy amount of deals.
That's
so
right.
It's like the same guys that were common equity were now doing credit deals, and they're like, wow, this is a great return.
100%, because they're either making high teens returns or mid-teens return on their money, and if they end up owning the asset they bought,
they got at the number they said
80,
that they wanted.
Or 90%
yeah, it's crazy
of what they should have paid.
So
That's what I'm seeing.
I want to talk about something you said a while ago, which is the positive sentiment in the market with regards to interest rates going down. On my side, I'm not seeing any positive sentiment because, and I want to kind of...
You're a workout attorney.
hold on. But that's because they had to borrow money from their friend, from their confidant, whomever, to stay afloat. So
Leo, there's a difference between a new perspective of somebody new looking to deploy new capital into the market versus legacy problems that people have. If you borrowed at 3.5% or 4% and your mortgage is maturing, if rates come down 100 basis points, it's not helping you. Instead of going to 8% or 7%, you can borrow at 6%. That's still a huge increase. Legacy issues still have to be worked out, and that's why we have to get through this capitulation phase to clear the market out, to get rid of all the negative positions people are in.
Because they're waiting for it.
You know what's interesting about that? Yeah. And it's the sentiment, and we're talking psychology. The smartest, largest funds and firms in the universe, what did they do? They rip the Band-Aid off. You're hearing about it. They're handing assets back. They're giving them away. They go, we get it, and we're out. So the head of the Comet, and Bob probably deals with it as well, know what the story is. Get rid of it. We have a loss. Time is short. We have a certain amount of capital. We got to go get paid.
But I'll tell you something. They're not going to do that. My guys, my borrowers, my developers, they're not going to do that until they get through those modifications, until they get through litigation. I have a fear that the capitulation is not going to come as soon as you may think, Bob. I think it's going to take another. Well, let's estimate. I'll go around the room and estimate. Is it 2 quarters? Is it 4 quarters? Or is it 6 quarters that capitulation is going to come about? My vote, and you might not believe me, I think it's going to take 8 quarters for that capitulation to come. And litigation is a very, very serious thing. And there has to be a flush in the market, the flushing of the toilet to clear all of the sludge, right? And I don't think that's going to happen unless we get into fights. But I want to hear from Rich. What do you think? When is capitulation going to happen? When are people going to start selling?
I think that the capitulation, it gets derived in 2 sectors. You have retail buyers and you have wholesale buyers.
Okay. Talking about Blackstone related?
No, I'm talking about there are 5-year mortgage mature dates that happen for multifamilies. And then you have the retail buyers who are buying 30-year properties, 30-year household primary residences, which are not controlling the consumer market, but can give you a clear indication of which way the market's actually headed. I think for the 2 markets, you may be closer to 6 months, multifamily game.
Okay.
6 months, which is how many quarters?
2.
2 quarters. A good estimate. And for the primary residence, I would say that we're just about there. We're just about there.
That people are going to start selling.
People are going to start selling, people are going to start buying, and the rates are going to start reducing. And don't count it out. It might turn the market into a bliss. It might light a fire under everybody. They cannot unwind these rates too quickly. Because, all right.
Why?
Let's have this conversation. If everyone's not buying, what's all the money doing?
Sitting and being restructured.
People are like, yo, the first opportunity I get, because in 2015 I missed it. In 2019 I missed it. In COVID I missed it. The first opportunity, guys are sitting on cash for 5-6 years now.
Merchant cash advance.
People are holding their money tight. When the moment they start reducing these rates, and the best thing that Bob said is it's almost nearly impossible to time it. So you're really kind of just gambling, like, is it now or is it in 60 days? But Bob will tell you better than anybody because he's been in the business longer than 3 of us have been alive.
I don't know about that.
Don't date him like
I'm
that.
pretty old.
My daughter tells me I was born in 1462, so you might be right.
Bob will tell you that 60 days, 90 days, 100 days, 200 days, the saying is, don't wait to buy real estate. Buy real estate and wait. So even if capitulation's in 4 quarters or 6 quarters.
Or 8 quarters.
Or 8 quarters, it's a pretty good time to buy.
Well, here's my point. And I'm curious.
Well, what are you going to say, Eric?
Bob's opinion. I'm saying the smartest humans capitulated, okay? Not the smartest. The biggest funds with the most money that run our markets capitulated already. The mid-market space, the sentiment.
Yeah, I want to know about that.
The $10 million marketplace hasn't. There's a lot more emotion.
But I'm
involved.
telling you that they're going to be restructuring for the next at least 4 quarters.
You know,
you don't think so?
I think that Cap,
He
the
doesn't
same
think so. He
people,
doesn't think so.
the same
why?
people
Why?
that are losing money are the same people raising to get back in, is my point. Mid-market is emotional. These guys, girls, and these people, these are assets they've owned forever, and they forgot that it's a business.
And that's why I'm saying it's going to be at least 8 quarters.
I think that there is such a dearth of product coming on the market, especially in multifamily. I can't talk about data centers. I can't talk about industrial and its
Office
impact.
spaces, right.
But there is such a need. I feel as if that the government is going to step in, assist, and that takes, just so you know, if they speak about it today, 9 months to a year. So it should be faster, but there's no way it's going to be quicker than 9 months to a year.
But people are going to gear up for that. People are
We'll
going to
see.
gear up. The second they hear any rumor about 421A, people are getting locked
Well,
and
it's an
loaded.
extension. It's just the existing.
They're
He's saying that an asset that has a foundation or a one poured, that's a finite amount. Do you know exactly how many units that could be?
The estimates are 25 to 35,000.
Guys, that's nothing.
Well, no. Here's the problem with
That's
that. Here's the
nothing.
problem with that. and I'm curious your thoughts on that. The rate on the financing is still more expensive. So the acquisition price, putting that footing in and then stopping, does not change the underlying economics of that project. So why should it immediately start? Should that original developer just take a loss and the new buyer coming in will immediately start?
But you're assuming that they're not in litigation.
What he's saying is they're playing chicken right now. Basically, they're hoping for an extension. They haven't started the project. Maybe they have a loan on the asset.
I don't think they're playing chicken. They know that 2026 comes up.
They're not playing chicken because you were unable to get a construction loan.
Correct.
Because the bank, even though the deadline was June of 26, the bank wanted you to prove you could get the TCO by June of 25. Because nothing ever goes according to
By the
plan.
way, part of the mediation that I was having just today on the $76 million loan was, can you get this project done within 14 months, within 12 months?
Is it scratch?
No, it's half built.
No, it's half built. But that's what was happening. They made it a contention in the contract.
How can you sign that though? That's just that.
Well, I'll tell you how you can sign that, because the restructuring process works as follows. When you sign a deal like that, sometimes you have no choice. And if you have no choice, you got to go bankrupt. And if you got to go bankrupt, you get another 90 days. So that means if you agree to 14, you'll likely agree to 17. If you agree to 17, you'll likely agree to 20. And that's the value.
Those are the interests are aligned. Like, it's different. Those
Yes.
interests
That's
are aligned
working. That
between you and your enemy.
Right, but I want to hear what Bob has to say. Is it how many quarters? Is it 2, 4, or 8?
All right. Well, Richie kind of touched on it a bit. My answer is going to be it depends. It depends, and it depends on one of the key factors of how this correction has played out differently than the past corrections we've seen. In this one, two big differences. One, lender behavior is very, very different than it's ever been before. Secondly, each product sector is performing differently. So I would argue it depends what asset class you're talking about. I argue retail in New York City today is on the upswing.
Yes, that's correct.
Because it's been battered for so long that rents, everybody thinks rents have stopped going down. Leasing activity is picking up. Investor demand is back. Retail's fine.
Yep.
Businesses are good.
How about construction development sites?
Construction development sites, I think it depends. What are you building?
Multifamily.
And where are you in the process? How
Condos,
much of the building has been built?
rentals.
All of these things.
Projects that are finishing. Let's talk about 2024. Let's say he's asking when. So projects that are finishing 2024.
Yeah, I'm really
It's going to take a while. Did you have floating rate debt? Did you have fixed rate debt?
Can I tell you something? Okay. I have a client, 19 projects, restructuring $2.3 billion in debt and equity. You know what he told me? He's like, Leo, figured it out. I was like, tell me, Joe, what'd you figure out? I'm about to blow up this podcast. 2, 4, 8. I'll tell you why it's going to be 8. Because he's like, nobody's transacting. Everybody's defaulting. You know what I'm going to do on all my properties? I'm going to default. I'm going to restructure by forcing the lender to work with me.
What'd I say? What did I say before?
So 19 projects, $2.3 billion in assets, mixed use, commercial, all types. Retail's on the upswing. He cannot fill half of what he has. It's all in New York City, Brooklyn, Queens, Manhattan. He said, you know what, Leo? I'm not going to stress. I'm going to default on everything. Please call your lawyer. Do not default on everything.
This is not legal advice.
This is not legal advice. But he's like, I'm going to default on everything, and then I'm going to start my massive workout.
Yes.
Because at the end of the day, if I have 19 projects in aggregate of $2.3 billion, a 25% reduction in my equity is going to yield me. How much is that? Of 2.3 billion, it's like $200, $300, $400 million. He's like, that's what I'm going to do. I'm not going to start building these assets. I'm going to start flipping these assets, because flipping them once I have a workout is going to yield me more money in less time.
And
He's like,
no stress.
and less stress in building. He's like, I don't want to be a developer. I want to be a flipper of my mixed use projects. And that's why and it's very hard. It is taxing. When they come to me, they're like, I've defaulted on everything. I get them 6 months to 9 months out, 10 months out. They're like, you know what? I don't care. I want to be in default because the market is shit. I'm going to take advantage of it. And lenders are giving borrowers money to walk away. They're like, you know what? We don't want to be in litigation with you for 2 years. We'll give you $1 million to walk away. We'll give you $2 million to walk away. And Joe, the one that has 19 projects, is now like, look, I took 2 from here. I took 2 from there. I took 3
I'm
from
up
here.
$40 million, baby.
I'm up $40 million. And you might think that that's not what's happening. That is exactly what is happening. Because every mediation, arbitration, litigation that we're in, if you have good, competent counsel,
The banks can lose.
the banks can lose.
And lose big.
And they could lose big, especially I also have a client that has a portfolio with the bank, 2, 3 loans, 4 loans, and they're at the mercy of the borrower.
So how many developers are going through this right now? How many of 100
I would
clients?
say probably 1 in 4 are going through this, about 25, 30%. And that's a lot, guys. That is a lot because that tanks the market. And that's why you're feeling this sludge. You guys are talking about interest rates. You guys are talking about 421As. I've been listening very, very carefully for the past 45 minutes about what the capital market, the broker and the developer are thinking. But the insight from the restructionist is very, very real. That's why I don't think it's going to be 2 quarters. I don't think it's going to be 4 quarters. I think it's going to be 6 to 8 quarters because everybody's realizing they have to default on their loans. Again, there is an appropriate time. There's an appropriate method. And I want to be very clear to our audience that defaulting on your obligations is not a good thing.
It's not legal advice either.
It's not. But what I'm saying is people are taking advantage of the market, or maybe they're not taking advantage of it. Maybe, Bob, they're just dealing with it. They're dealing with the market
That's
as it
what
comes.
I think it is, by the way. I think people are just dealing with it. They don't. By the way, and a lot of developers or litigators, they don't know how to deal with it.
Well, it's a dance. It's a dance between the lender and the borrower, and the lender is very, very tough, but the borrower is becoming smarter. It's better to be a smart borrower that's in default than be a silly borrower that doesn't have a way out. And the only way to do it is actually to have a capital advisor, a broker, another developer with another ear. Another thing for borrowers and developers, and even lenders, know what your asset is worth. And that's why we have Bob. We're working on a matter with Bob right now. It's a stalled condo project, I believe, 66 units. We're going to have Bob at that mediation because the lender needs to understand what the value of that asset is.
So you know what they're doing now? Lenders are actually requiring in meetings with their board advisory team. So do you bring not only your architect, your contractor, your broker, developer, and investors pre-construction lending?
That's interesting. Tell us more about that.
So you're going to get a $20 million construction loan. You got a term sheet signed. Everything's about to be said and done. You submitted all your rental fallbacks, your condo scenarios. You submitted all your expenses, your timeline, your projection. You give them your Gantt chart, meaning everything outlined with the specifications of the model numbers, right? They say we'd like to have a page turn meeting, contractor, architect, personal guarantee guys who are your investors, developer, and the whole board present.
I think he's right. I think that moving forward into 2024, the future of development is going to be a closer affair with the lender and the borrower. I think just like in 2008, the lenders became extremely cautious with their lending practices. I think the lender and the borrower are going to go through a sludge match, 2, 3, or 4 or 5 quarters, and then they're going to realize we're actually in this together.
Can I just touch on that for a second?
Of course.
I got to run out. I just want to...
Yeah, we got another minute and a half, boys.
I just want to touch on something because it's not as often. We got litigator, we got capital infusion guy, and we have...
Broker.
I don't want to call him a broker.
Broker advisor.
He's more than a broker. It's Bob Knackel, but we could say broker. You know...
And we have the developer.
The only person that we need to be really putting the pressure on is the individual that's structuring the deal. And we need to do so tactically. There's a strategy. Like, I love what you're saying. You need to call Bob and say, hey, Bob, I'm buying this development site. What can I get price per square foot if I need to fire sale? Call Eric. Hey, Eric, I need to know what's my capital going to cost me on a preferred, on a mezz. I need to understand that if tomorrow things go bad because force majeure, war, COVID, rates go up, we've seen everything in the last 5 years. What can I get? Can we get somebody to replace my position? Call the litigator and say, okay, all my bells and whistles are in. I got a term sheet from the bank. What can I sign and what shouldn't I sign in the event I default.
Right.
And when you do these things in a strategical manner, and you do obviously you're doing your due diligence in construction and architecture,
Of course,
and
of
you're doing
course.
your primary research on who's buying. You sync those things together. Tomorrow, you don't have to guess. Am I buying? Am I selling? Am I going to default? What about the buildings in Manhattan that are being bought by $250, $260 million? The loans are maturing today. They're not getting rid of them for $150 million?
50 million? 35 million?
Yeah, listen, human nature is short-term thinking. There will not be that kind of due diligence.
But I'll
I
tell
can
you something.
guarantee you that in
What's up?
a year.
We're talking in this podcast, and we've been talking about these themes for so long already. It's been a year since we've been talking about these themes. Believe it or not, this information is not accessible to the public.
To the average guy, for sure.
To the average guy, even to the astute, really, really smart investor, they don't know these things.
Yeah,
They've been. I had a client intake. It was a Persian Jewish developer. I'm talking about billions of dollars, and he for the first time didn't know what to do with one of his buildings, but he was extremely out of touch with the market. And the same goes for a Greek developer that I was speaking to. It doesn't matter. Distress is agnostic to your religion.
Doesn't have religion.
It doesn't have religion, ethnicity, nothing. But a lot of what we're talking about, people are not aware of, and they should be educated about it. I mean, we don't have too much time. It's been an hour since we've been on the show. Jacob, I wanted to thank everybody for being here.
Yes, sir.
Richie, thank you so much. Bob, it's a pleasure as always.
My
Eric,
pleasure.
it's a
Eric's
pleasure as
pleasure.
always.
Thank you,
What a
Until
dream
next
team.
time.
Yo, if there was an all-star game, this would be the dream team.
This would be the dream team.
The dream team had 5. This is 4.
Any last moments? Any last things that you guys want to say? Please, Eric. Good.
No, just thank you for having. You're up to a bunch of shows now. It's amazing.
Yes.
And I know that I am cautiously optimistic for 2024 and 2025 in New York City. I think that we've sludged through the bottom and the swamp long enough. It's time to rise again.
Yes, it is. And Bob, what your thoughts are? Really, what your thoughts are on the development field? How it's going to be moving forward? Tell us a little bit about that.
I think there's still a lot of pain to go through, but what I tell people to feel better is that the market always has been, is, and always will be cyclical. It will come back, and good times are ahead.
That's right.
But nobody knows when. We just have to take it one day at a time, and I think you're going to be busy for a while.
Thank you, Bob. Thank you, everybody.